Hey everyone, Brian Bogner and Greg Towner here. It's time for our December update here with Parallel Portfolios. And we're going to take a little different approach today. As you well know, we've had a lot of market volatility and we've been getting a lot of questions from clients. So we're going to take those top three questions and we're going to go ahead and answer them today. Here we go. So starting with question one. With the recent market volatility, what do we do now? Greg, you want to talk a little bit about that?
Yeah, I think the good place to start with that is one of our favorite topics, investor behavior. And then we'll evolve it from there. But let's just focus on the right side of this chart, the right column. What this chart is it's looking at individual investors invested in the Vanguard S&P 500 ETF. So they're actually in the index, which should replicate the index. Over a 10-year time period, those investors returned about 3.5%, whereas the S&P was about 7%. So they only captured about half of the S&P's return, even though they are invested in the S&P. So how does that happen, right? It's because they weren't invested in it throughout. They as it ran up, I got to buy more. And then as the rough periods like we're having right now, they bailed and said, oh no, I got to get out. I'm smarter than the market. So even though they were literally invested in the S&P, they only got half of that return. That's key behavior.
Yeah, half of that return. And it looks like here for value and growth ETFs, it looks pretty similar as well. Maybe a little worse for value. And I think where that comes from is I get the same thing, like, why aren't we doing anything? Why aren't we got to be doing something. The markets are going down. We got to sell, got to do this, got to do this. And there is some of that goes on. But the reality is, trying to time a top or time a bottom is near impossible. And we have just been complacent for so long now. We've had these nice, easy runs up in the market that we're experiencing some volatility that we've been saying, hey, everyone, this is normal. This is actually what happens. And we got a few slides here later on that point to this. But I think this is good. This is good that what we typically feel like doing is the opposite of what we should be doing in the market. And that's why we don't, as investors, always get the returns that the market gives us.
Yeah, and I think a lot of investors, they tend to think about an all-in or all-out mentality.
Right.
And that's gets them into trouble. I mean, we talk all the time about risk management. Right. Big believers in using stop losses and
right.
raising some cash. Still big believers in that, but not all in or all out.
Right.
You have to have a balance there. Absolutely.
Right. All right, our next question here is, how much longer will this decline go on? How much longer, when is this going to end? I hear a lot. And the reality is we don't know. Nobody knows. So anyone that is telling you, or you see something on TV and they say, well, they said this could happen for 6 more months or 2 more months or 3 more months. The reality is they don't know. Nobody knows. Okay. So we don't know how long this decline is going to go on. However, here are a few things that we do know when we look at the market. And Greg, I'll let you go ahead and take over here.
Yeah, so let's look at recent history as somewhat of a guide. This is a 10-year weekly chart of the S&P 500. That blue line, roughly following the big arrow, is a 200-week moving average. You can see over the last 10 years, as we've been in this uptrend, it's corrected a couple of times down to that area. Used it very nicely. So it's possible that could happen again. That line, it keeps increasing, so it doesn't mean we're going to go all the way down to the price it's at now. It could gradually work its way. As we look at the two major declines or corrections we've had, one that was kind of in the 2011 period, and then one that was in the 2015-16 period, both of those corrections lasted about 6 months.
Mm-hmm.
Their percent decline was kind of in the 15 to 20% range, Brian.
Right.
Right now, we've been in the correction mode about 3 months.
Right.
We're down on the S&P about 13%. Certainly, a lot of stocks are down much more than that. A lot of international markets are down much more than that. So, we're maybe roughly halfway through in time would be our best guess. But of course, like you said, we don't know that. We do think one other interesting period to look at on this chart is the 2014 through, call it 16 period. We had about 2.5 year period where the market essentially did nothing. Maybe it didn't feel like it at the time.
Right.
You had some volatility. But in hindsight, it just kind of went sideways. Sometimes that's what markets do. They have to work through some things, and we're working through a lot of things right now and quickly. So, maybe it can happen quickly or it can happen through time. So it's hard to say, but, historically in the last couple of corrections, it lasted around 6 months.
Yeah. And when I hear things like bear markets, the reality is, here's the low back in '09. Okay. Again, we're still in this long-term uptrend. Like, we've not seen a change in these long-term trends yet. So, while this is painful, when you really go and look back, we're still in an uptrend right now. All right. Are there any positives out there? So there's a lot of negatives, right? Headlines tend to be negative. People, if you just had positive news headlines, nobody would watch. So no wonder. That's why we tell people, turn off the TV, don't watch the CNBC and that nonsense. We don't watch it. I don't have a TV in my office. We don't, when Greg and I started in the industry, we would consume that stuff all day long. And then we realized there's just a lot of noise, and there's just a lot of attention-getting headlines that have very little substance to it. So that's why we don't tell clients, don't watch it. We're going to watch it. We don't even watch it either, okay? We've got research and things that we follow and very specific things that we look at that help us make decisions. TV is not one of them. So, all right, I'll get off that soapbox now. Are there any positives out there? Yes, there are. Greg, why don't you go ahead and talk about this slide here?
Yeah, by the way, I'm glad you did that soapbox this time. I'm usually the one saying avoid the noise, so thanks for taking that for me. But yeah, valuation, we actually thought valuation has been decent all year, and now it's a lot better. This blue line is forward PE. It's really had a disconnect from the market itself here. And, they can kind of converge towards each other perhaps. But as we look out to next year, yes, earnings are going to slow. They're going to be slower than this year as far as growth because of the tax cut. But we still think there's some pretty decent value out there, and particularly in some quality investments.
Right. Another thing too here I want to bring out, we've been talking a lot about in the international space and emerging markets. Of course, China's been getting a lot of headlines here with the trade wars and things like that. And really since the high in January, right, in both the U.S. and international, if you remember, the high in U.S., we went down, but then we went back up and exceeded the high. Well, the international markets, right, has been really going down most of the year. However, if we compare the two here over the past couple months, so this is simply a ratio of comparing emerging markets to the S&P 500, we're seeing this line start to turn and rise now. So, 2017 was a great year for international. 2018 has not been a good year. We potentially could be seeing that turning, and we're going to be keeping a close eye there as well. So let's go ahead and sum this up. All right. Like we said at the beginning, you got to focus on your long-term plan. Okay. Avoid the noise. It's the reason why the actual market return versus investor return, the investment return is usually half of that, because investors tend to make the wrong decisions at the wrong time. So that's why we need a plan, focus on that plan, be rules driven there. Second thing is we're halfway through our recent time length of corrections. So, if we just take the last few corrections and create, the actual length of them, if we apply that to this one, we're halfway through that. So that's a positive. Usually a good amount of the damage, for lack of a better word, has been done. Just as I said a few seconds ago, emerging markets, international is improving some, valuations are improving worldwide, so things are looking a lot more attractive from a valuation standpoint. And then the thing that we just want to leave you with is that the next 10 years, okay, are likely not going to look like the last 10 years. What we had going on since that low of '09, where we had a very accommodative Fed policy, we've had, interest rates moving lower. We've had a number of things, okay, kind of lining up and providing certain tailwinds and headwinds for the market. Those things for the next 10 years are going to look very different, okay? So what we tend to do is we tend to take what we've just experienced and we extrapolate it out over the next time frame and say, well, this is probably how it's going to look like. And what we're trying to tell you is it's not. It's most likely going to look very different. So we encourage you to adjust your expectations to consider that. Okay. So as always, if you have any questions, give us a call, shoot us an email. Thank you for your time today. And we hope you have a wonderful Christmas holiday. And if we don't talk to you, also a Happy New Year from us here at Parallel Financial.